This LOS is describe potential benefits of alternative investments in the context of portfolio management. Alternative investments. A key motivation cited for investing in alternative investments is their diversifying potential. There is a perceived opportunity to improve the risk-return relationship within the portfolio context. Given the historical return, volatility, and correlation profiles of alternative investments, combining a portfolio of alternative investments with a portfolio of traditional investments potentially improves the risk-return profile of the overall portfolio. The correlation between some categories of alternative investments and traditional investments has historically over long periods been low, or at least less than perfect, providing diversification opportunities. However, there are challenges. These include getting reliable measures of risk and return, identifying the appropriate allocation, and selecting portfolio managers. So here on the right-hand side, I have something, this is outside of the CFA curriculum, but I very much like the JP Morgan Guide to the Markets. If you Google search, you can find that it's a free document that you can find on the internet, and this is where I found it. And so you can see here, this is exactly what we're talking about. This is our return on the y-axis and our volatility, our risk on the x-axis. And we can see that we have a 30% stock, 70% bond portfolio, 50-50 stock and bond portfolio, and the 70-30 stock bond portfolio. And of course, this would be in the long run with regards to return and risk, okay? And in their guide to the markets, they're then adding some alternative investments at each of the levels. So you can see here 20% stocks, 60% bonds, and 20% alternatives, okay? And you can see this is exactly what the argument is that they're decreasing the risk and increasing the return, okay? Here at the middle level, instead of a 50-50 stock bond, they're doing 40 stocks, 40 bonds, 20 in alternatives. Again, they're increasing the return and maybe slightly decreasing the volatility at each level. And then finally, again, in their graphical representation, this portfolio here, 60% stocks, 20% bonds, 20% alternative, you can see it's got a higher risk with, a higher return, less risk than the 70% stock, 30% bonds. So again, this is saying that there's it can potentially improve the risk-return profile of the overall portfolio. Returns to alternative investments. Managers of portfolios invest in one of two basic ways to achieve returns, passively or actively. Passive managers assume that markets are efficient and focus on beta drivers of return. Beta, a measure of sensitivity relative to a particular market index, is a measure of systematic risk. Active managers, whether in alternative or traditional investments, assume that inefficiencies exist that may be exploited to earn positive return after adjusting for beta risk. Alternative investments are generally actively managed. Actively managed alternative investment strategies reflect several characteristics that differentiate them from long-only passive investments in traditional assets. Active investment strategies, these are not mutually exclusive, can be categorized as follows: absolute return, market segmentation, or concentrated portfolios. Continuing with some information here now on hedge funds, the potential portfolio diversification benefits are: 1, low correlation with traditional investment returns; 2, higher average returns than traditional investments. However, return measures are biased upwards, risk measures biased downwards, survivorship bias and backfill bias. So don't forget, in some hedge fund indices, the reporting is voluntary. So if a fund ceases to exist, they won't report anymore, and that results in the survivorship bias. Now, one of the things that I want to point out here, I wrote this, that in the text, they're dealing with some old data, okay? In terms of this table, they're doing risk return characteristics of hedge funds and other investments, but it's 1990 to 2009. So you need to be careful with the start date and the end date anytime you're looking at investment returns, okay? So here they have the annualized returns. You can see that the fund of funds for the hedge funds is beating the global stocks. And this is what they're talking about, higher average returns. But I said be very careful with the timing period with regards to the global stocks, okay? And the annualized volatility is less than the global stocks, so that's a little bit surprising. So therefore, you're going to get a better Sharpe ratio, okay? This is my own slide, and it's the stock market since 1900, and it was from the JP Morgan Guide to the Markets. And I just wanted to point out on the previous slide, we were looking at data from 1990 to 2009, and we were comparing some of the hedge funds versus long only on the equities. And you can see, I just wanted to circle that in 2009, the ending period for that data was a very low period for the market. In fact, when you had the global financial crisis in 2008 and the markets came down, that was the first time ever that for the S&P 500 that you had a 10-year negative return, okay? So when you're looking at that previous table, as I said, you always got to be careful with your start date and your end date. Look at the asset class that you're comparing and going back and look at the start time and the end time and look exactly the period that you're looking at, because depending on what you choose as your start date and what you choose as your end date, you can get some really different returns, okay? So that's just something I want to point out that you need to be careful with. A little bit outside the curriculum, but a key point that I wanted to make. And we'll just finish this LOS with one quick practice question. An investor is most likely to consider adding alternative investments to a traditional investment portfolio because A, of their historically higher returns, B, of their historically lower standard deviation of returns, or C, their inclusion is expected to reduce the portfolio Sharpe ratio. And the correct answer is A, based on the table that we saw in the CFA curriculum. The historically higher returns to most categories of alternative investments compared with traditional investments result in potentially higher returns to a portfolio containing alternative investments. The less than perfect correlation with traditional investments results in portfolio risk, standard deviation, being less than the weighted average of the standard deviation of the investments. This has potential to increase the Sharpe ratio in spite of the historically higher standard deviation of returns of most categories of alternative investments, okay? So that's the last slide for this LOS. Thank you.